Hi, Professor Barati here. Since this week's discussion and assignments covers the area of fraud, detection, and reporting regarding auditing, I thought I'd share with you uh, a very high profile um, audit disaster from 2000 to 2001, uh, which led to the Sarbanes-Oxley Act in 2004, as well as the bankruptcy of Arthur Andersen, one of the biggest accounting auditing firms in the industry, who was WorldCom's auditing firm. WorldCom at the time was one of the largest and basically hottest communications company in the industry. Their stock was very highly regarded at the time, and what happened basically with WorldCom was normal operating expenses, which get deducted from revenue and affect the net income and earnings per share. The normal operating expenses for that industry were being capitalized as assets and then depreciated over many years. It's as if you were buying trucks or office furniture. It's the difference of you were buying regular inventory and putting on the books as assets instead of cost of goods sold. Or if you were paying employees and fraudulently classifying that as an asset instead of operating expense. So in this case, I'd like you to just go through this, because this PowerPoint, it will give you how fraud and auditing, some of the concepts you're learning in this year's class, like knowing the industry, assessing risk, how to assess risk, which is very important. Is the company under pressure to meet earnings? Is the stock declining? You will know in the study of WorldCom that their stock was declining and they were under pressure to get the stock price up. You will also know that the CEO was giving a large loan by WorldCom, which is a red flag when it comes to auditing. There were so many things going on at WorldCom that were red flags. Evidence, when the auditors wanted receipts or invoices to prove that they purchased these so-called assets, the auditors were not able to get the invoices or proof that these assets were actually purchased. Documentation on fraudulent journal entries classifying expenses as assets were not made available to the auditors. In the case of evidence, sometimes a firm's ability to present evidence quickly and in an organized way is what the auditors are actually looking for rather than the actual evidence itself. By not or delaying evidence, when an auditor asks for receipts or some kind of invoices, and then they have to wait weeks and weeks for that information, and the company is just delaying it, hoping the auditors will forget about it. Sometimes that evidence, not the evidence itself is risk, but the fact that the auditors can't present it is even a bigger risk. And then from that, you can do more testing and do more auditing. So these are all facts that came out from the WorldCom audit, and indeed the WorldCom debacle has become actually a case study in auditing. So if you will see here in this PowerPoint, basically operating expenses, salaries, insurance, equipment rental, electricity, they basically are normal operating expenses. They are matched. It's the matching principle to revenue for that period, and therefore it determines your net income. Capital expenditures result in the acquisition of or improvement to the company's assets. Example of capital expenditures are purchases of real estate, manufacturing equipment, computer equipment. Capital expenditures are not counted against revenues on the income statement. Instead, they are booked as capital assets. They do become expenses through depreciation over a period of time, over what the company determines as the useful life of an asset. One key red flag in an audit is if the company normally determines that the useful life of a group of assets is 5 years, and all of a sudden that method has changed to 7 or 10 years. That could create a red flag. Keep in mind, companies do have discretion and have internal policies to determine these estimates on their own. However, the consistency is very important to an audit. Accounting fraud 1 in WorldCom, improperly releasing reserves held against operating expenses. WorldCom has set reserves to pay anticipated bills reflecting estimates of unpaid costs. In the third quarter of 2000, WorldCom starts to manipulate true line cost expenses. Line cost expenses are the costs they have to pay to use other companies' lines to transmit data. Okay? And in the meantime, that line is billed to their customers as revenue. So they were taking normal operating expenses, the cost that they used other companies' lines to move data is a normal period cost. They were taking that cost and they were putting it on the books as assets. So here under this heading describes how they actually did it. They basically had accruals released without any apparent analysis of whether the company actually had an excess accrual in the account. They reported line costs of $3.3 billion. $3.3 billion of normal operating expenses were put on their balance sheet. Characterizing certain expenses as capital assets. Line costs, fees WorldCom pays under long-term contracts with third-party telecommunication carriers, are normal operating expenses. They typically reach 50% of revenue. By booking line costs as capital assets instead of an operating expense, WorldCom reduced their operating expenses, increased the value of their capital assets, and increased the value of the company's net worth. WorldCom starts making false general ledger entries, which transfer a significant portion of this expense to capital accounts. This is not GAAP reporting. They approximately capitalize 3.5 to 3.8 billion of these line costs. How is this fraud uncovered? WorldCom employee sent a featured article to an internal auditor indicating that the issues raised in the article might warrant investigation. The article was from May 16th, and WorldCom employee who was allegedly fired for whistleblowing. WorldCom Internal Audit Department began an investigation. On June 12, 2002, the internal audit team contacted Max Bobbitt, the chairman of the audit committee, $2.5 billion in line costs that had been capitalized. Mr. Bodbert requested these issues be discussed with their auditing prior to the audit committee. Prior to June 2nd, the board determined that WorldCom would restate its financial statements for the first quarter of 2002. WorldCom acknowledged it committed more fraud than it originally reported, raising the estimate to $3.8 billion, to $7.2 billion, and then to $9 billion. WorldCom overpaid taxes and sought to recover $300 million in federal tax payments that made it to cover up its fraudulent activity. Misrepresenting cash position to analysts as solid while facing cash crunch. WorldCom continued to issue securities using fraudulent and material false financial statements. American investors in WorldCom lost an estimated $176 billion in value. They had to lay off 25,000 employees and cause another 73,000 job losses in the industry. Of course, they filed for bankruptcy. WorldCom is the poster child for corporate governance failures. I highly recommend you just read these PowerPoint slides because they'll give you a very good understanding about how auditing failed, and you'll see that areas like evidence and risk, you'll be able to apply that to the theory you're learning. Here's another article from the New York Times about the WorldCom auditing collapse. It describes what happens quickly, but it also talks about auditing because it's written by it's written by New York Times, but it quotes a lead CPA, longtime accountant from Arthur Andersen. And they talk about the auditing theory that was basically would have easily picked this up had the auditors just simply used accounting 101 theory. You tailor the audit to the risk that you are facing, which is common sense. On the score, Anderson should have been especially careful with WorldCom and accounting analysts at Lehman Brothers. Not only was the company's share price in steep decline, but its accounting practices had already come under fire and question had risen about huge loans by the company to its chief executive, Bernard Ebbers. That should have been a red flag. After determining the scope of the audit, outside auditors are supposed to focus on three broad areas when dealing with a company as large as WorldCom. First, do an analytic review of the client's draft financial reports. By doing that, the auditors would have saw that their capital assets were soaring while their expenses as a percent of revenue were declining and not within the industry average. That would have caused the red flag right away. Auditors should ensure that a client's internal procedures are reliable. So here they're talking about internal controls and testing those. Finally, auditors should examine the documentation backing as sampling of the company's transaction. Again, testing and evidence. Did the auditors ask to see the contracts of these line programs that they were putting on the balance sheet as an asset? Did they do inventory? Did they do, any kind of testing such as that? So basically, this is another very good article you could read about. And you could apply some of the accounting 101 principles to it. I'm also going to take out a few paragraphs here and add this to the discussion if you want to do some other posting, add to your post to get full credit. Thanks for watching.